really need some kind of a trauma, I'm afraid, to have anything happen here. And I just don't see it. I just don't see anything that's going to cause a collapse in confidence that it is going to be meaningfully addressed in Washington. They don't want dollars. What do they want? What are they going to do? Take their dollars, cut them up with scissors, flush them down the toilet? They're going to sell them to somebody else. And then what are they going to do with the dollars? I mean, they don't disappear.
Hello and welcome to Soar Financially, a channel where we discuss the macro to understand the micro. My name is Kai Hoffman. I'm the @JR Mining guy over on X, and of course, your host of this channel. And I'm looking forward to bringing back Dr. Gary Shilling. He's a famous economist and, of course, the president of a Gary Shilling and company. Really looking forward to catching up with him on the overall U.S. economy and the market situation. We've seen the Fed Chair Jerome Powell testify in front of the House today, and I have a couple questions coming out of that. And of course, we'll have to discuss what is the current debt situation in the U.S. How are we going to shrink the debt? Is there even a way out of that looming crisis? Lots to talk about with Dr. Shilling. But before I switch over to my guest, hit that like and subscribe button. It's a free way to support our channel, and we tremendously appreciate it. Thank you so much for doing that, Dr. Shilling. Thank you so much for joining us on Soar Financially.
Delighted to be back with you.
Yeah, really looking forward to our conversation. We have lots to discuss, and I'm really curious to hear your opinion on certain topics that we just briefly touched on before hitting the record button. But I've decided to change things up a little bit. We always ask us, like, oh, what's the state of the economy? He's like, this time I want to find out from Dr. Shilling, from you, what are you most excited about in the markets and the economy right now? What's something positive?
Yeah, I think it's positive in a sense that a lot of people think is negative, and that is what is happening, largely instigated by Trump. Now, he's mixing things up and says a lot of things that you really wonder if he's thought about. But what is happening here is that we're in a big transition. If you look back after World War II, the U.S. was the leader of the free world. And we were supporting the free world. And basically, one of the ways we did that was to allow everybody else to export to the U.S. That was a way that they helped recover in Europe and Japan. And it really was a situation that resulted in a huge and growing trade deficit in the U.S. Now, that helped the rest of the free world recover. And it was a lot cheaper than garrisoning U.S. troops around the world during the Cold War. But I think that has come to an end, and I think the invasion of Ukraine really was the capstone of that, because it in effect signaled that Europe was going to have to take care of Europe, that Ukraine was largely the responsibility of Europe and not the U.S. Earlier, Europe had basically been spending its time and resources on social programs and leaving defense of the free world up to the U.S. But I think now, and this is one of the things that Trump came in, and Trump obviously makes some very decided changes. But I think this was something that was coming anyway, and the whole idea that it was up to Europe to support Europe, in this case Ukraine. Now that obviously tied in with the huge and growing trade deficit in the U.S., which has been a problem for years, and it has resulted in huge problems that have not been thoroughly recognized. As you know, I've been talking about this for the last few years, about the growing trade deficits and current account deficits, and of course the budget deficits, and what this has really meant. And it has received very little attention. I've been talking to the wall on this one, I'm afraid, but now it is getting attention, and people realize that there is a limit to this. We haven't gotten there yet, but I think all these things are coming together, and it is a different world. And we're no longer the U.S. supporting the rest of the world. The rest of the world, the free world, is much more responsible for itself.
No, absolutely. Like 80 years, exactly 80 years post World War II, as you said, like I think we are seeing a changing order, turning more into a multipolar world. Would you agree with that? Like who are like what is let's call it 80 years plus one. What does the new multipolar world look according to Dr. Shilling?
It, yeah, it is multipolar. It's no longer the U.S. supporting the free world and everybody else going off and doing whatever they wanted to. A lot of it was social programs, but it is now much more a multipolar kind of world. Europe is really being forced to take responsibility much more for Europe. And as I've mentioned before, I think that the Russian invasion of Ukraine was the signal. That was the trigger mechanism. We also see, of course, the situation in Asia, and Japan has not really taken a lot of responsibility yet for containing China, but I think that will be coming too. And we're seeing that a lot of trade fights there, China trade dominance and huge exports. A lot of it coming to the U.S. That's being challenged. It's moving to other countries: Vietnam, Thailand, Bangladesh, you name it. So you've got a lot of things going on, and it's no longer this easy kind of simple deal. Now, of course, things never look simple except in retrospect. It's always, last year was simple. Now it's really tough. But I think in perspective that there has been a diminution of a bipolar world into a multipolar, and it is creating a lot of challenges that are yet to be worked out, and it'll take years for them to get resolved.
Yeah, it opens a lot of box for a lot of questions here, Dr. Schilling. Like you touched on the U.S. military, for example. Lots of bases around the world. We've just been reminded that U.S., for example, has a base in Qatar and in Iraq, and just to name a couple of all the bases they have. But to sort of get back on the spending and cut back on the spending, do you see those being rolled back? Because it is completely upsetting the world order, as you hinted at. Like, how effective and like how long term is that thinking when it comes to that? Because it's been 80 years in the process to get to today. How long will it take to roll that back?
Uh, Good question. I sure don't think there's an easy answer, but I do think that it isn't going to be immediate. I mean, the facts are that the U.S. dollar is the global currency. 89% of all the transactions affecting trade or capital flows in the world involve the dollar. So this just doesn't happen overnight, and there's no real substitute for that. The euro, they got enough problems. Japan doesn't want the yen to be a global currency. China wants their currency to be a global currency, but they want to control it. And international currencies and control by their sponsors just don't work. Uh, that's never worked historically. So so the dollar dominance is very important to this. And even though there's a lot of concern about the dollar and other countries that say, oh, we really don't want as many dollars. Well, if they don't want dollars, what do they want? What are they going to do? Take their dollars, cut them up with scissors, flush them down the toilet? They're going to sell them to somebody else. And then what are they going to do with the dollars? I mean, they don't disappear. So the U.S. dominance in the financial area is something that would is if it's going to change, it's decades in the process. So that's one of the things that is just going to continue.
I was going to ask, like, how much longer is that dollar dominance possible? Given we touched on the debt situation, for example. Eventually, like we're all predicting it will blow up. It has to blow up because it's not sustainable, of course, or it cannot be sustainable. Of course, there's always innovative ways probably to mitigate that, but like realistically, can the dollar stay the world reserve currency? Does it even have a chance? Is probably the question. Like from
Well,
a
again,
positive aspect.
you got to remember in any financial transactions, there's two sides. There's a dollar, and then what's on the other side. And if there's nothing on the other side that matches the dollar, it isn't going to change. I think that's the basic reality. Now, one of the things that I have been, as you know, been emphasizing for a number of years is the growing um, debts and deficits of the U.S. And we've zeroed in on we really zeroed in on the interest on the debt as as deficits continue, they add to the debt. And if interest rates are higher, that makes it even more so. So we look at the interest on that debt and say, hey, wait a minute. The interest on the debt is part of the deficit. In other words, you got to pay that interest, and that's part of the deficit year by year. And the point is that as that grows, it can start to accumulate geometrically, and at some point, you say, wait a minute, we call that a debt bomb. That's I've been talking about that for a number of years, a debt bomb. Now, you don't know how long that can last, and what happens. Does eventually everybody say, I don't want dollars. They're just so what are they going to take instead? But it is a troublesome factor, and it's only been within the last few months that others have been worrying about that. And in a way, I'm glad that other people are joining us in being concerned, and it does show that there is concern, but so far there is no movement to do anything about it. You look at Congress, and what are they doing? The House has passed a bill. The Senate is probably going to be very similar, and it's going to increase the whole debt by a couple of $1 trillion in the next 10 years. There's absolutely no conviction to do anything about it. And what congressman, what senator, or even president wants to do anything about it? It hurts constituents. You look at all the things that are going now to contain spending, and somebody's hurt. You look at Medicaid. No, they're talking about constraining that. Well, that takes money away from these people or those people or so on. Hey, nobody talks about when they got all that money, but boy, when it's no longer there, it's the devil personified at work. It's a very difficult political issue, and so you really need some kind of a trauma, I'm afraid, to have anything happen here. And I just don't see it. I just don't see anything that's going to cause a collapse in confidence that it is going to be meaningfully addressed in Washington. Historically, the way that it was addressed, and this was after World War II, was economic growth. If you got economic growth, then you're getting more tax collections, and that can offset spending increases by Congress. But it doesn't look like we're going to have that rapid revival of post-war growth in the near future. So I just don't know if there's anything that's going to arrest this. But again, you sort of say this can't continue forever. Okay, why not? What's going to stop it? I don't know.
Yeah, I've been saying on this program quite often that I see, or that I cannot shake the feeling that the US is going the way of Japan. Eventually, we'll sit at 250% debt to GDP. The central bank will have to buy its own debt, or the Treasury debt, and it's just a circle. It's just, and eventually the US or the dollar becomes irrelevant, like the Japanese yen, powerhouse back in the early 90s, completely disappeared. And now it's just the cousin that you have to invite to any party because it's part of the family. Right?
Fair enough, but what's going to replace it?
Yeah, no, good point. Good point. And I have another, almost cheeky question because you talked about the interest being half of the deficit currently. How high do you rate the chances of a U.S. default on that debt when it comes to that? Is there even a possibility?
I'd say very, very low because uh, the debt is issued in our own currency. I mean, that's the overwhelming reality. And if you're issuing debt in your own currency, and the rest of the world is buying it, and that's what deficits and trade deficits and current accounts are doing. They're pumping all these dollars into foreign hands. They get recycled into dollar investments one way or the other, as I mentioned earlier. Uh, but that process continues. And unless everybody said, no, we don't want dollars. Okay, fine. What do they want? what, what are they going to
Yeah.
get in replacement? Uh, that's yet to develop.
I feel like you're setting me up here, Dr. Schilling. Like it feels like you want to talk about gold. We have to talk about gold. But
I hate to disappoint you, Kai, but I am agnostic about gold, and I'll tell you why. Uh, there's so many forces that can affect the price of gold: political risk, economic risk, trade issues, and if you look historically, we had gold. Back in the '80s, it got up to over $300 an ounce, or skyrocketed from when it was $24 an ounce, and then it stayed there for 20 years, and that's in nominal dollars. It was declining in real terms, in inflation-adjusted terms, and the thing is, there's so many forces that can push gold around, and I just don't know how you sort those out. And is there anything that says that gold is eternal? Um, I don't think so. Uh, it certainly has been around a long time, but I don't. I just say I'll leave that to other people to worry about gold.
no, fair enough. But personally, I see gold as the only, let's call it a currency that I would be interested in others maybe than the dollar. I live in the euro area, but if that wasn't a possibility, I wouldn't be, the renminbi. No, no interest,
Do
to be
you own
honest.
gold?
I do. Yeah,
Where do you
I
keep
do.
it?
I can't tell you. No,
You got a lumpy mattress?
I don't sleep well. Like,
Okay, fair enough.
no, but in all seriousness, we got to talk about increasing potentially tax revenue. And President Trump has been trying to do that through tariffs. I'm really curious what your thoughts on that are, because we're coming up to July 9th is the end of the tariff pause. Do you see that situation be resolved satisfactorily from the U.S.
Well,
point of view?
yeah,
Like,
we have a monthly newsletter called Insight, and we've written about this extensively. And by the way, if anyone listeners would like a sample copy, be happy to send them one. But I think the reality is that the whole tariff issue is being way overblown. Uh, the popular view is that you put on tariffs, it increases prices, the buyers suffer, and end of story. It's not that simple at all. What happens? You put on tariffs, and so buyers shift to other sources where the tariffs are lower or there are no tariffs. Sellers they produce goods in different areas, and you get all through. If you look at what's happened in the last couple of months, now it isn't all played out yet, admittedly, but you've had virtually no increase in wholesale or consumer prices, and yet those tariffs have been there. And I think at the end of the day, that the tariffs are actually going to be disinflationary, lower inflation, not higher inflation. And the reason is because of uncertainty. I think that's the biggest impact of tariffs is a tremendous uncertainty. Producers don't know what to do. They've got to shift to other sources of production. As I mentioned earlier, buyers shift to other sources of supply, and that whole process is very disruptive. And I think that slows down economic growth, which is disinflationary. So my feeling is, at the end of the day, that contrary to popular belief, that the tariffs are going to be disinflationary, not inflationary.
we talk about that disinflation versus deflation. I think we need to. I want to take a look at that with you because deflation means like the consumer waits to purchase. It's not just a drop in price and the consumer's happy to buy it, but deflation means the consumer expects future prices to be even lower, meaning economic growth will be on halt or pausing because the consumer's waiting to buy at a
Yeah,
later
yeah, that's
point.
an argument I've been making for literally decades, and that's why I use the word disinflation, meaning lower inflation, but not deflation, meaning actual declines in aggregate price levels. And you're absolutely right. If you do have declines in price levels, people's wait to buy. And of course, that means you get excess inventories, you get excess supply that pushes prices down. people say, "Hey, suspicion's confirmed." They wait even further, and it's a self-reinforcing downward spiral. Uh, Deflation is probably not terribly likely, and one of the reasons is because we and most developed countries are, and even developing countries like China are more and more service oriented, as opposed to goods oriented in terms of purchases and production, and services prices just don't tend to fall that much, even if there's excess supply. You look at medical services. Did you ever hear of a medical provider who said, we're cutting our prices because business isn't so hot? Oh no, no.
No.
These guys, if anything, they take more vacations or whatever. Cutting prices is just not part of their makeup. Um, so goods prices are volatile, but service prices aren't, and therefore I think the idea of actual deflation is highly unlikely. You'd have to have a real global economic collapse for that. But disinflation, lower rates of inflation, and that can result in somewhat the same reaction, because if you do have with disinflation declines in prices of some things, let's say in goods, let's say cars. I mean, if when we see this in cars, you see a rush to buy cars when tariffs are going to come down. Why can't you see a people holding off in buying cars if they anticipate lower prices in the future? So goods, things that last, durable goods, things that you don't have to buy immediately. There's no reason you can't have actual deflation in those. But to have this on a economy-wide basis, I just don't think is likely.
No, it's interesting because the Fed has been forecasting without saying or using the term stagflation, but they've been hinting at stagflation, meaning higher inflation, lower economic growth. Are you saying it like if you were to turn this around, are you saying the Fed is dead wrong on their assessment?
Yeah, I think so. I think that they are very much reflecting the popular image of tariffs that I mentioned earlier and tried to explain, and that is the idea that if you have tariffs, that prices go up, and that there are no offsetting actions either by buyers or sellers or in effects on the aggregate economy. And I think the Fed is just they have a different view on that.
Hmm. No, absolutely. It seems very different, and I'm curious, like from that point of view, or from your point of view, Dr. Shilling, should the Fed cut at the next meeting, or should they hike? Should they stay? Like, what should the Fed do?
Uh, I don't know that it makes a great deal of difference. They would get Trump off their back if they cut rates. Maybe that's the greatest impact, and of course he would claim victory. but
Of course.
no, I don't. I mean, bear in mind that the Fed operates on the overnight federal funds rate, and and the actions they take there spread throughout the yield curve. In other words, the overnight rate, let's say they cut it a quarter of a point. When you get out to 6 months rates, 1 year, 2 year, blah, 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 on out to 30-year bond yields, it has effects, but diminishing as you move out. And when you get out to 30 years, uh, those rates are largely determined by inflation. You look at the entire post World War II period, and the correlation between year-over-year change in consumer prices and the 30-year bond yield is the correlation is about 70%. It's very high, and there are a lot of other things going on, but that's the dominant feature. But on the shorter end, it is the Fed. So if the Fed acts, it has impacts. Probably the greatest impact is on the Treasury, because the bulk of Treasury issues are very short term. Less than a year or so. So that reduces the Treasury financing costs because they constantly have to roll over these short term bills. But um, it's more a signal than it is a big impact on the economy, in my view.
Dr. Schilling, we've managed 24 minutes without using the R word. We have yet to talk about recession. I'm curious, like, what are your recession odds right now, and which way are you leaning?
I think they're maybe 60% recession within the next year. Uh, you've got many of the very reliable inflation recession indicators, the yield curve, the leading indicator index. You've got some of these very reliable indicators which have been signaling recession for some time, and you also have other factors that I think would chime in there. Labor markets. The Fed doesn't seem that concerned with labor markets, but if you look what's happening, uh, job job offers are declining. Layoffs are it isn't so much layoffs that are increasing, but people aren't being hired. Um, Unemployment insurance, continuing claims for unemployment are have been rising for 9 months now. I think it's you've got a lot of indicators that suggest you could be in a recession. Now, bear in mind that recessions are not called by any administration or a central bank president, Fed chairman. Um, Nobody would want to be in charge of calling recession. That's left to a nonprofit group called the National Bureau of Economic Research, which first studied these back in the 1930s. And they wait until they get all the numbers in and the revisions. And it's usually at least 6 months after the fact before they make a call. Well, that's about as handy as a pocket in your underwear. By the time they tell you you're in a recession, it could be over. Um, but that's how it works. So when people talk now this sort of short term um, informal view was 2 consecutive quarters of decline in real inflation adjusted GDP. But that's not the sort of accepted norm. It's the National Bureau of Economic Research. But having said all that as a preamble, yeah, I think we very well could be. We could be in recession now or approaching it, and we won't know for at least 6 months, even if we were in one today.
Yeah, a lot of large agencies, OECD, IMF, World Bank have been calling for slower growth, but not negative growth.
Well, yeah, I mean, yeah, that's a no-no.
Don't do that. No, I'm really interested. Like we don't have time to run through all the separate indicators and markets like housing, job growth, wages, and things. But is there anything? Is there like one single indicator that we should be paying attention to? Is there anything that has you worried or positive right now?
Uh, Not really. Sometimes if you look back, for example, when we had the big subprime bonanza, you can say, boy, that is really cruising for a bruising. And we were lucky enough to be on top of that very early. But there's nothing that really stands out and said, this is absolutely guaranteed to collapse, and here's a likely time frame. But I think when you look at all these things, and then you look at the degree of speculation we have with uh, cryptocurrencies and a lot of other the Magnificent Seven. There are a lot of things that suggest that we're on pretty thin ice at this point. But uh, I don't. There's nothing you can really point to and say this is absolutely guaranteed that a recession is going to occur and in this time frame.
Okay. No, Dr. Shilling, I appreciate that. I think that's enough on the macro. Well, we got to talk markets real quick here as well. As we speak, the S&P 500 is roughly at 6,100 points. It's very buoyant, very positive, very bullish right now. What do you make of sentiment here?
I think there's more. I think there's a lot of money out there, and it isn't going anyplace else except into stocks. I mean, it certainly isn't going into housing. It isn't going into consumer spending. Um, uh, Consumers are borrowing very heavily, but it's so you're getting a lot of speculation in stocks, and the crypto area really stands out. But it isn't the only speculative areas. I mentioned the Magnificent Seven. You look around and people. It really started back with all the three waves of stimulus in response to the uh, pandemic. And where did that money go? It a lot of it ended up in stocks and has been there ever since. So I think you have a very vulnerable situation. You look at price earnings ratios, you look at price to book, all the sort of traditional indicators, and they tell you that stocks are very expensive.
No, absolutely. But as you said, there's only one home right now for the retail money in particular. I had a conversation with Lance Roberts yesterday, and he said he's saying the institutional investors are mostly, I wouldn't say, no, maybe I'm paraphrasing a little bit, but let's say institutional investors are on the sideline. It's mostly retail buying that's been pushing up the market. Would you agree with that? And
Yeah,
why is that
I
in your
think that
opinion?
I think that's true. I think that's true. If you look at what some of the major uh, uh, institutional investors are doing, and not that they are absolutely clairvoyant. They've made plenty of mistakes over the years, and it isn't just the small investors who are the last to know and the first to get killed. But yeah, I think I would agree with that analysis.
Yeah. No, fair enough. Maybe last question on the markets here in general. The term Goldilocks has been used quite a bit, and based on our conversation as well, it seems like nothing is really, and pardon my French, but out of whack. Everything seems to be balanced. If you look under the hood, of course, there's different rumblings depending on the indicator you want to look at. But overall, if you were to, broad stroke it, Goldilocks.
Well, bear in mind that things always look great right up to the point that they collapse. And then you look back and say, boy, well, warning signals were there. Why wasn't I paying attention? But yeah, I mean, if people were really concerned, nobody would be using the term Goldilocks. If you really were worried, stocks would be selling a lot cheaper than they are now. So this goes with the territory. This is exactly what you expect. Confidence is at its extreme at market tops, and it's nadir at market bottoms. So this is exactly what you expect.
No, makes sense. And maybe I forgot to ask, but we do have to talk about bonds real quick, or the bond market. I know you touched on it earlier, a lot of refinancing on the short end happening. But what do you make of the bond market in general? How happy are you with the term premiums that are being offered right now? What do you make of it?
Well, as I think you know, I've been a bull on Treasury bonds, and Treasury bonds are anything that's issued that will mature in 20 years or more. Just to be clear on the definition, notes are from 10 years to 20 years, and bills are 1 to 2 years. So anyway, yeah, I've been a bull on Treasury bonds. In 1980, the yield on the 30-year bond was 14.6%. I said then we're entering the bond rally of a lifetime, and since then Treasury bonds have outperformed the S&P, even though it's been an amazing run in stocks. They've outperformed it by 3 times. So I've got, full disclosure, I'm biased, but I think Treasuries are, we manage money in our portfolios. We're emphasizing Treasuries. We're emphasizing the dollar. These are traditional safe havens, but I think they are the place to be right now. And I think on the other side of the ledger, I think commodities are vulnerable with global weakness probably going to unfold. And stocks, as I mentioned, I think are way overpriced.
No, really interesting assessment there, Dr. Shilling. Towards the end of our conversations, we like playing games with our guests, meaning we play higher or lower. Quite binary. I just ask you about the asset class or the macro indicator, and you just say, by the end of the year, it's going to be higher or lower, based on your opinion, of course, right? Let's start with inflation. Higher or lower by the end of the year?
Lower.
Unemployment.
Higher.
The 10-year.
Lower. Yield.
10-year yield, yeah. Sorry. S&P 500.
Lower.
Dollar/Dixie.
Higher.
Gold.
Agnostic. No comment.
No comment. Okay, no, fair enough. Then I don't have to ask about silver because that's usually the last one. So, no, fantastic. I really appreciate your time, Dr. Shilling. It was great to speak with you. Where may we send our audience to follow more of your work?
Well, you can send them to our website. It's a Gary Shilling, www.agaryshilling.com, and we can we can answer any questions, or if they'd like a sample of our newsletter, we can send them one. Be happy to do that.
Fantastic. Dr. Shilling, it was a great pleasure to have you back on. Time just
Uh,
flew by. It was a breeze. Really appreciated it. And we'll have to do this again after the summer. Really looking forward to catching up again.
Okay, okay. And
Thank you so much.
maybe it'll be a little cooler in the New York area.
Oh, I hope so. I'm working out of my basement and I don't have air conditioning, and it gets warm with my computers and the light and everything.
Well,
So,
I think we're looking here at about 30 degrees Celsius today.
yeah, I think we're 28 right now.
Yeah.
So, and it's just getting dark now. So it's 9 p.m. So,
Okay.
Dr.
All
Shilling,
right.
thanks so much for your time.
All right.
Everybody else, thank
Good
you
to be
so
with you.
much for tuning in to Soar Financially. I hope you enjoyed this conversation with Dr. Shilling. I tremendously enjoyed it. And if you have any questions, any comments, please put them down below. And there's a free way to support us. It doesn't cost you a thing. Just hit that like and subscribe button. We really appreciate it. Thank you so much for tuning in. We'll be back with lots more here on Soar Financially. Take care out there.